In this session, we are going to talk about NPAs. Okay, so non-performing assets. Non-performing assets. So we will discuss about non-performing assets in detail in this session. So first, what I'll do is I'll discuss what is non-performing assets. Okay, and then I will discuss about the type of non-performing assets, and if time permits here itself in this session, I will talk about various measures, or if I cannot complete that in time, I will discuss that in the next session. So let's start with the definition. You know, if a loan is default for more than 91 days, that is considered as non-performing assets. So if you see NPAs, the loan which is actually, if there is a default on installment, okay, of principal or interest for more than 91 days. So let me write only this more than 91 days default only. So more than 91 days default on the payment of installment of interest or the principal. So this is what NPA. Now if you go for the classification of NPAs, you will see substandard assets, doubtful assets, loss assets, and all this different categories. You will see bad debt, all this we'll see. So I'll take one by one and I'll explain it, and we will move further and we will explain it completely. So the classification. So classification of NPAs. Okay, so first one, substandard assets. So substandard assets. So what do you mean by substandard assets? If it remain NPAs for less than or equal to 12 months. So a loan which is already defaulted, which is already part of NPA, but NPA for less than 12 months. Okay, so let me write here, remain NPA for less than or equal to 12 months. Okay, so less than or equal to 12 months. So NPA less than 1 year. So 91 days default already crossed, so it's part of NPA. So it's already NPA and then less than one year. So if it crossed beyond 1 year, then there is another classification. So let's see the different types of classification. Second one, doubtful assets. Doubtful asset. So it means the bank loans or the NPAs which remain NPA for more than 1 year. Okay, so NPA for remain NPA for more than 12 months. So both are related to NPA. So this substandard assets is NPA, doubtful assets is NPA, but the first one within NPA less than 12 months or 1 year, and if it goes beyond 12 months or 1 year, then it will be doubtful assets. So it will be classified under doubtful assets. Now the third category is loss assets. Loss assets. So this is remaining NPA for more than 12 months. That means this condition has to be satisfied, remain NPA for more than 12 months, and is considered as non-recoverable by the auditors. Okay, so this condition has to be satisfied, that the second condition. So it has to be a doubtful asset already 1 year is crossed as NPA, and it has been classified as non-recoverable by the auditors. So for example, even if it a loan or in any case the principal or interest installment is remaining NPA for that loan remain NPA for more than 1 year, but maybe you can recover the loan because there may be collateral. Okay, so you might have pledged something for getting the loan, so bank have the confidence of getting it back in any way. It may remain NPA for maybe 1 year or more than that. It may be doubtful asset, but the bank may be able to recover it through the legal process. Maybe collateral will be there, your house might have pledged. Okay, so that is not coming here. Here loss assets means the auditors classified it as non-recoverable. For example, educational loan and all, there is no possibility of collateral over there. So especially we are talking about the loans which are not having any collaterals. Okay, so auditors classified as non-recoverable. So I'm not writing it completely. So I hope you understood the second condition. The first, this one, it has to be a doubtful asset. That condition has to be satisfied, and then the auditors made it as classified as non-recoverable. Okay, and the fourth one, but it is made it as non-recoverable, but it has not been written off from the balance sheet. Still it is there in the balance sheet, and that will create problem with the balance sheet. And I will discuss this concept in terms of balance sheet syndrome, and this balance sheet syndrome, double balance sheet syndrome, etc., which are used in economic survey, and it was actually asked as prelims question. I'm going ahead, and in the coming session, in the coming in 20 minutes I will be coming to that particular concept. So I'll discuss that balance sheet issue and how writing off will help the maintenance of balance sheet issue, the problems. We will discuss that, how to solve the problem of balance sheet syndrome, etc. we will cover in the next 20 minutes. So what I'm saying is, this is a loss assets, that means NPA for more than 1 year, and it is understood that non-recoverable, but still it is part of your balance sheet. Bank is not writing off. Okay, so there are two ways in which you can clear the balance sheet. One is write off the loan, secondly you give it to ARC. I'll talk about that, what is ARC and how this working, and etc. we will discuss. Okay, so it is non-recoverable and not written off. Not written off. So I hope this is clear what you mean by loss assets. Last one is bad debt. Bad debt. So this is a loan which is actually written off from the balance sheet. So written off from the balance sheet. So I hope you understood these four classifications. Substandard assets remain NPA for less than or equal to 12 months. Okay, doubtful assets remain NPA for more than 12 months. So both are NPA, but one is less than 12 months, the other is more than 12 months. Now within this, loss assets remain NPA for more than 1 year, and it has been understood as non-recoverable but not yet written off. Bad debt, NPA for more than 1 year, non-recoverable, written off from the balance sheet. Okay, so that's the most important four classifications of NPA. Now apart from this, you will see something like special mention account, etc. So I'll also talk about that. Even before the loan reaching that NPA status, bank can have some measures by classifying into seeing the issues with respect to a particular account. You can see the account is vulnerable, the loan account is vulnerable if one installment is not paid or second installment is not paid. So you can make a classification on that basis also, and you can prevent a loan account getting into the status of NPA even before 90 days. So for that purpose, there are different other categories of accounts also, loan account. One is, or we will see, special mention account. Special mention account, that is SMA. So these are bank loans in which there is a default of up to 90 days. So here default up to 90 days. Okay, so 90 days or less, or I can say 1 to 90 days. If there is a default of 1 to 90 days, then this is part of special mention account. So 90 days cross, 91 and more, that is NPA. So up to 90 days default, special mention account, it requires special mention, and the bank have to take care of this loan account, because there is a possibility that will move on to NPA status. Firstly NPA status, then different other status that we have actually discussed, and towards the end it can be a bad debt, it may not be recoverable, it has to be written off, and all those issues will come. So to avoid all these, you have to maintain a loan account from the stage of special mention account. And special mention account, you can see further classification. SMA 0, the first one, SMA, special mention account 0. So here default up to 30 days. Okay, so here if it is 90 days, basically 3 SMAs are there, so you can see 30 division. So first 30 days, so default up to 30 days, and showing the signs of weakness. So you can see if an installment is not paid for the first month, which one is used to pay, you can see a sign of weakness. Okay, so from here onwards you need to take care of that. So that means up to 30 days. Okay, so default of up to 30 days, and signs of weakness, Second one, SMA 1. So this is 0, then 1. So here it will be default up to like 31 to 60 days. So 31 to 60 days, that is considered as SMA 1. Then the third one, SMA 2, right? So the default from 61 to 90 days. So 61 to 90 days. So these are the three different special mention account. So special mention account before reaching NPA status, but still default is there. So up to 90 days default special mention account. Three type of special mention account: SMA 0, SMA 1, SMA 2. SMA 0 default up to 30 days and showing the signs of weakness. 31 to 90 SMA1, so obviously weakness is there. Now SMA2 is 61 to 90. It is clear cut that it is going to reach NPA status. So you need to take care of this special mention account so that you can prevent the increase in NPAs. Okay. Now you will also see in banking terminologies like restructured loans or assets. Okay. So what do you mean by restructured loans? Restructured loans. See, restructured loans are like this. You might have taken a car loan, or not car loan, any loan, maybe for small scale industry. You might have taken a loan for example, let's say 10 lakh loan you have taken, and you have paid some installment. Let's say you paid for 2 years. Okay, so after 2 years you are facing problem in the payment back. Okay, so what you will do is it may go to NPA, so you can talk to the bank and you can restructure the bank. So for example, this 10 lakh you are supposed to pay in 5 years and you paid for 2 years. So let's say in the 2 years, let's say you paid around 4 lakhs. So you paid around 4 lakhs already in 2 years. Now you are struggling, you are not able to pay. So 3 years more you need to pay, 6 more lakh you need to pay. So what you can do is you can restructure the loan with the permission of the bank. Bank will do that so that bank can prevent this becoming NPA and bad debt. So bank will restructure this loan. This 6 lakh, the 3 year may change to another maybe 5 year, okay, or maybe 6 year. So what will happen? The installment that you need to pay will be reduced. So it may be within your payment capacity. So this is what you mean by restructured loan. So let me write it here. It is a bank loan. It is a bank loan whose terms and conditions are relaxed by the bank to accommodate the concerns of a defaulting borrower. Okay, so this is a restructured loan, so the banks will accommodate the concerns of the defaulting borrower and restructure the loan. May change the installment, may extend the number of years, like that. Now what about stressed asset? So when you talk about the bank, what do you mean by the stressed assets of the bank? Stressed assets of the bank include NPAs, outstanding NPA, plus the restructured loan. Both will be part of stressed assets. Okay, so stressed assets is equal to, I would say, NPA plus restructured loans. Okay, so this is the not stressed banks, stressed asset. So stressed assets of the bank, NPA plus restructured loans. Now what do you mean by cleanup of balance sheet? Cleanup balance sheet. Cleanup balance sheet. Okay, so cleanup balance sheet means actually remove bad quality assets. So that's about bad quality assets. So if you see the balance sheet, I've already shown you many times. On one side there will be liability of the bank and then assets of the bank. So what do you mean by the bad assets of the bank? If you see, the assets are basically cash and loans, right? The assets of the banks are loans. So cash and loans. Now what are the different types of loans? You can classify SMA. Now you know what is SMA. So that is the initial stage of becoming NPA. Then you have NPA. Once it becomes NPA, then you have substandard category. Then you have doubtful category. Okay. Then you have loss category, loss assets. So these are the category. So doubtful, up to this it's okay, but doubtful you understood that this is non-recoverable. So this is what you mean by the very bad quality assets. So you have to remove this from balance sheet. So that is what you mean by cleanup of balance sheet. Now there are two ways, there are two options with respect to the banks. So what are the two ways? You can either write off. So when you write off, what will actually happen is this is considered as loss. So who will lose the money? The owners will lose the money. So what will happen? The capital will reduce. So owners' capital will come down. Now when the owners' capital will come down means it is going to affect something very important that we have discussed already. Okay, that is CAR, capital adequacy ratio, or capital to risk weighted assets ratio. We have discussed this in detail, and in fact it is uploaded in YouTube also, and you can watch the video. I have explained what is CAR, capital adequacy ratio, capital to risk weighted asset ratio, how is it calculated, what is the need for it, what are the Basel norms, what are the RBI guidelines. Everything is crystal clear. So if you attended that video, it is very much clear for you. If the bank is writing off a loss asset, what will happen? The capital will reduce. When the capital is reduced, now banks cannot lend more because you have to satisfy the requirements of RBI guideline, right? So RBI guideline is like 9% capital adequacy ratio should be there. So when writing off, what will happen? Capital adequacy ratio means capital to risk weighted assets. What is the risk weighted assets? These are loans. So this what will happen when you write off? The capital will reduce, so numerator will reduce, so this 9% will come down, so you cannot lend now. So what you need to do, you need to infuse more capital. So this will actually affect the lending capacity of the bank, and bank may, it may affect directly the profitability in all way around also. So that is a big problem if you write off. Second option, you can pass this to ARCs, okay, asset reconstruction companies. So how is it done? Banks will pass on to ARCs and at a discount price. So let's suppose the NPAs, let's say 10 lakh. So there will be a negotiation between ARC and the bank, and based on the negotiation, this will be the loss assets will be transferred to ARC, and then ARC will recover it through legal channels. Okay, apart from this, there was proposals for bad bank, etc. We will discuss about all those concepts in the coming sessions, but here understand this is the two ways in which you can actually clean up your balance sheet. One, you need to write off, or you can pass on to ARCs. Whatever you get, based on the negotiation, that will be fine, and that you can add to the capital. So you may need to infuse some little more capital only. Okay, so this is given upon a discount. So then what about asset quality review? Asset quality review, AQR. So RBI conducts survey. So it is actually a special survey. I'll write here. It is a special survey like drive conducted by the RBI to ensure proper classification of assets. So especially NPAs. Okay, so we have seen already the different types of classification of NPAs. So asset quality review is a drive which is conducted by RBI to make sure that proper classification of assets. See, the main problem is actually NPAs are consistently increasing in India. So if you see 2012 NPA level, that is around 2.7%. But now if you see 2018-19, if you see NPAs, that is around 8-9%. Okay, so this is consistently increasing, and out of this, public sector banks, if you talk about public sector banks, their NPA is more than 10%. So public sector banks NPA is more than 10%. So all these are concerned. So, and what you need to do is you can check for different sectors, the contribution of different sectors, like metal sector, how much it is contributing, textile sector, infrastructure sector, and which one among this is the largest. So these are some minute questions which can be asked in prelims. So you can go through that. For example, metal sector 14%, infrastructure sector, that is 34%. Similarly, textile sector, these are actually the biggest contributors of NPAs also. Okay, so when we talk about metal sector, especially steel, that is the case. Okay, so the main reason is actually the competition from China in case of steel. So that go NPA. Okay, then infrastructure, when we discuss about, that is mainly because of policy paralysis, right? So I'm not getting into that here. I will be discussing all those things in different other modules. In fact, we have already discussed, for example, this problem with land acquisition, highways, Land Acquisition Act, anyway we have discussed, so I'm not getting into that. So here only sticking to NPA. Now let's quickly discuss about the causes of NPA. What are the main causes? The causes is slowdown in domestic and global economy. That is one important reason. So slowdown in domestic and global economy. Second, excessive lending by the banks. Excessive lending by banks during boom phase. That means boom phase means before the subprime crisis, 2008, before that. Okay, so the third one, defective credit appraisal system. Defective credit appraisal system of borrowers by the banks. Next one, very important one, policy paralysis, and this was actually asked as a question in 2014 essay. Okay, essay was related to policy paralysis. So policy paralysis, especially between 2011-14. So this period, after that new government came, and there are a lot of issues during this time, we all know that. So policy paralysis during this time. Okay, many stalled projects, stopped projects. Okay, all these are important. So high interest rates. So during this time you can see high inflation. So because of high inflation, RBI kept on increasing the policy rate. So that led to high interest rate. So because of high interest rate, the burden passed on to the customers or the consumers, or that led to default. Okay. So then high leverage ratio. So high leverage ratio, this is also known as, capital gearing. I'll explain what is this. Capital gearing, okay, or it is also known as it can be understood in terms of debt equity ratio. So when you read the newspaper, you will see debt equity ratio. It is nothing but debt to equity. I'll give you an example with that you can understand. Let's suppose there are two people or two firms, firm A and firm B. Okay, two companies. Both companies invested 10 lakh and 10 lakh and started a business. Okay, same business, same way it is functioning, same expenses, same outcome. Imagine in that case, because investment is same. So, but this company, that entire 10 lakh is the equity. There is no debt. Okay, there is no loan, there is no debt, full equity. So let's say the company made a profit of 30, let's say 3 lakh. Okay, 3 lakhs. So what is this 3 lakh? What percentage of investment is this? 30% of the investment. Compared to the investment of the owners, it is 30%. Now imagine a different case. The company B, they started borrowing. Okay, so they have 5 lakh with them. They have borrowed 5 lakh. That means there is a debt. So 5 lakh is actually the loan or the debt. So here also they are making a profit, same 30 lakh. Now when you understand, let's suppose this 5 lakh is borrowed at 10% interest rate. So how much you need to pay? 50,000 you need to pay out of this. Okay, so 3 lakh you got, and from the 3 lakh you will pay 50,000 interest. So that is gone. How much is balance? 2.5 lakh. So 2.5 lakh is the profit. Here entire 3 lakh is the profit. Here 2.5 because you are paying the interest. But still here if you see as a percentage of investment, this is 50%. Right, here only 30%. So in case of profit, more debt you have, more profit will be there in terms of percentage. If you see more the debt, more profit you will get. Okay, for example, if you consider this as 2 lakh as the investment and 8 lakh borrowing, same situation if you consider. Okay, let's suppose 3 lakh profit is there and 8 lakh borrowing at 10% you need to pay 80,000, right? 80,000 you will pay. So how much is left out? 2,20,000 is left out, right? So 2,20,000 is what percentage of 2 lakh? It is more than 100%, right? So you're getting more than 100% profit, 110% profit you're getting. So what I'm saying is the debt to equity ratio will be, it should be greater in some cases because they prefer to go for more debt, because in case of profit, this is going to give a lot of advantage. But there are problems with debt to equity ratio. That is the reason why NPAs are increasing, because borrowings are increasing. Debt to equity ratio is high means the borrowings are so high, right? That may lead to NPA. Now imagine here itself, if there is a possibility of loss. Here we have discussed about profit. Now if we talk about loss, let's say, or low profit, only less profit. Okay, so let's say 50,000 is the profit. Okay, only 50,000 is the profit. So you can say first company, he is getting 50,000 profit and entire 50,000 profit, that is 5% of his investment. But he is getting 50,000 profit and this 50,000 will be given as interest. So effectively he left out with nothing. So 0% profit. So what I'm saying is, if the debt to equity ratio is high, in case of profit, you will get better margin in terms of percentage. In case of loss, the loss will be also higher. Okay, so in case of profit, the profit will be higher. In case of loss, the loss will be higher. And debt to equity ratio you can understand in this way. So if company is doing better, it is always better to have more debt because the profit will be high. And that's why during boom phase, lending will be more. During boom phase, that means company is doing better, so more profit will be there, so more lending will be there, because the company is also getting benefit out of it. More debt means better, more profit. Okay, so when we talk about leverage ratio, is actually risk of the company is actually increasing. The leverage ratio will actually tell you the risk of the company. So high leverage ratio means debt to equity. The more debt means the company is in risk. Okay, so it actually shows the weakness, or you can say if the leverage ratio is high, it shows what? It shows the weakness of the balance sheet of the company. So it shows the weakness of balance sheet of company. So this shows the risk of the company, right? Risk of company is actually high. So leverage ratio is high means risk of the company is high. So the weakness of balance sheet of the company, it is reflected, and this is what you call as the balance sheet syndrome. Balance sheet syndrome. Before also I have talked about balance sheet syndrome in case of banks. So here if you see why this balance sheet syndrome is there, because debt is high, right? Debt is high. Debt is high, that's why debt to equity is high. That means leverage ratio is high. What is leverage ratio? Debt to equity. So debt is high. Debt is high, so the company's balance sheet problem is there. At the same time, when the debt is high, the chances of NPA is also high. So if NPA is high, the chances of loss asset is also high. That means bank's balance sheet is also in problem. So more the borrowing, there is a problem with the company's balance sheet as well as the balance sheet of the bank, and this is what we call as double balance sheet syndrome. Okay, double balance sheet syndrome. Actually this was there in this was mentioned in Economic Survey 2017. So double balance sheet syndrome, so it is a most important sign of weakness. High debt, you can see high debt and high leverage ratio, so most important sign of weakness of the company. If it is in boom phase, it is perfectly fine because you are making more profit. But if the profit is coming down, or if in case of losses, there will be huge losses. Okay, and in case of loss, the bank will also suffer. So that shows the balance sheet problem of the company, and it will affect the balance sheet of the bank. So the double balance sheet syndrome. So okay, so I hope you understood. On one side debt is increasing, on the other side NPA is increasing. Leverage ratio is increasing, bank's problem is also there. So that is the double balance sheet syndrome. Not exactly double balance sheet syndrome, twin balance sheet syndrome. Okay, twin balance sheet syndrome. Okay, next concept is financial repression. Financial repression. I'll write down first and then I'll explain. It refers to compelling banks to lend in low yielding securities. For example, what is the low yielding securities? The government security, right? So compelling the banks to lend to low yielding securities means what? I have already discussed with you under which instrument RBI will compel the banks to lend to government. We have already discussed SLR, right? SLR means certain percentage of the certain percentage requirement that the bank have to keep it with themselves. It could be in terms of cash, it could be in terms of gold, okay, it could be in terms of GSEC, government securities. So cash, there is no return. Ideal, it will be kept. Okay, so bank won't prefer this. Gold will be calculated at a constant price, so that won't be a better deal. So banks prefer government security. So what do you mean by compelling banks to lend to government or lend in low yielding security? So if SLR is increasing, banks have no other option but to buy the government security. When banks are buying the government security means you are lending to government at a very low interest, right? The GSEC is offering very low interest, so that is why low yielding interest. So this question was actually asked in prelims, which among the following monetary policy instrument is actually used by RBI to compel the banks to lend to government? It is SLR, because you need to maintain in terms of government security. Okay, so why you have three choices, but better is GSEC for banks. I hope you understood the reason. If you didn't watch that videos, all the videos are available in the Telegram channel. Please subscribe that and you will get all the videos over there. Okay, so here, so that's what, or on risky areas, right? So low yielding securities or on risky areas. So what do you mean by low yielding security? I've told you, SLR requirement. Risky areas means the priority sector lending. Okay, so here you can see a new concept, that is double repression. double repression. So on one side, the asset side. So what is the repression? I've told you this PSL, there's a lending, you are forcing the banks to lend to the priority sector lending. 40% you need to lend. So this is one thing, priority sector lending and SLR. So this is from the asset side. What about liability side? Liability side repression means what? See, liability is what? The liability is what? The deposits, right? The bank's liability is actually the deposits. Assets is actually the loans. So this is affecting the loans, right? SLR is increasing means you can't lend. At the same time, you need to purchase government security. PSL is also asset, but risky asset, okay? So when it comes to liability, it is a deposit. How is it affected? It is because of inflation. So when inflation is high, the real rate of interest is low, so people won't deposit in the banks. So if let's say 10% inflation and 10% interest rates given by bank, the net interest is actually zero, right? I've explained this concept before in the chapter of inflation. Now we don't have time, already 30 minutes have closed, so I'm stopping it here.